2 years ago, this house in Austin, Texas sold for $550,000. That same house is back on the market today, and the seller just accepted $412,000. That's not a market correction. That's $138,000 gone. And here's the part that should make every homeowner in America uncomfortable. The seller wasn't celebrating a sale. They were relieved someone showed up at all. Austin was supposed to be untouchable. Tech jobs, population growth, Sunbelt momentum, it had every ingredient the experts said guaranteed appreciation. And it still lost 25% of its value in under 2 years. But we're not here to talk about Austin. We're here because we've been running the numbers through the latest data from Zillow and Redfin, and right now, there are 10 cities repeating Austin's exact pattern, step by step. Same inventory signals, same buyer collapse, same warning signs, just running about 18 months behind. If you own a home in one of these markets, your equity may already be at risk. If you're trying to buy, this data could save you from catching a falling knife. And if you've been waiting to sell, what you're about to see changes the math on how much time you actually have. We're going to walk through all 10 cities with the real numbers, not the headline averages. Because the median prices you're seeing in the news are not telling the full story. Nearly half of active listings in these markets already have price cuts. The media just hasn't caught up yet. And here's what you absolutely need to stay for. At the end of this video, we're handing you a 3-step survival playbook. One move for homeowners, one for buyers, and one for sellers. These are the specific strategies the sharpest analysts are executing right now, and they could be worth 6 figures to you depending on which side of this market you're on. One more thing, city number 4. When we dug into what's actually driving that market down, it had nothing to do with interest rates or inventory. It's something entirely different. And honestly, it's the one that hit different when we saw the data. Don't skip ahead. You need the context to understand why it matters. All right, let's get into it. Before we start, drop a comment right now and tell us what city are you watching or what market are you currently in. Whether you're a homeowner, a buyer sitting on the sidelines, or someone who just sold, let us know below. We read every single one, and your market might be on this list.
So before we get to the list, you need to understand why these markets are breaking down. Because if you think this is just about interest rates, you're looking at the wrong variable entirely. There are 3 ingredients that turn a cooling market into a crashing one: jobs, building costs, and buyer age. When all 3 align against a city at the same time, prices don't plateau, they drop, and they drop fast. Here's what most people missed about Austin. Between 2022 and 2024, the tech sector shed over 92,000 jobs across the major Sunbelt metros. Not layoffs that got reversed, gone. And when the people who drove the pandemic buying frenzy lose their income or their remote work flexibility, they don't hold, they sell, all at once. The second ingredient is construction costs. Developers locked in builds during the peak when lumber, labor, and materials were running $11,000 to $15,000 higher per unit than historical averages. They couldn't stop building. They had contracts, financing, and timelines. So even as demand started softening, new supply kept hitting the market. That's not bad luck. That's a structural oversupply problem that takes years to absorb. And the third ingredient, buyer age, is the one nobody talks about. First-time buyers, the group that traditionally absorbs entry-level inventory, now represent just 21% of purchases. That's near a historic low. Without that base layer of demand, move-up buyers get stuck, sellers pile up, and the whole chain stalls. When you see all 3 of these conditions in the same city, job contraction, oversupply, and a missing buyer base, that's the crash formula. And right now, it's active in 10 markets across this country. Let's start with cities 10 through 6. Coming in at number 10 is Colorado Springs. This market rode the Denver overflow wave hard during the pandemic. Remote workers priced out of Denver flooded in, and values jumped over 40% in under 3 years. Now that migration has reversed. Inventory is up over 60% year over year, and price cuts are appearing on nearly 1 in 3 active listings. The buyers who were supposed to come never showed up. Number 9, Baton Rouge, Louisiana. This one doesn't make the financial news, but the data is stark. Insurance costs in Louisiana have spiked to the point where monthly carrying costs on a median home have increased by hundreds of dollars without the mortgage changing at all. That's killing affordability from a direction most buyers never calculated for. Listings are sitting, days on market are climbing, and sellers are starting to blink. Number 8, Memphis, Tennessee. Memphis has the job loss problem without the glamour. Distribution and logistics employment, which surged during e-commerce growth, is contracting. The investor class that bought heavily here for rental yield is now watching rent growth flatten while property taxes and insurance climb. When investors exit a market simultaneously, it hits prices fast, and it hits them hard.
Number 7, Dallas-Fort Worth. Now, DFW is a big market, and it will survive long-term, but right now it is drowning in supply. Builders overcommitted to the Dallas suburbs during 2021 and 2022, and those units are all landing at the same time. In certain submarkets north of the city, active inventory has more than doubled in 12 months. And because DFW attracted so many investor purchases during the peak, a significant portion of current sellers are not emotionally attached. They're purely transactional. That means price cuts come faster and deeper. Number 6, Phoenix, Arizona. Phoenix is the one that should scare people because Phoenix has done this before. It was ground zero in 2008, and the pattern setting up right now is uncomfortably familiar. Inventory has surged back to levels not seen since the pre-crash era. The migration tailwind that carried Phoenix from 2020 to 2022 has effectively stopped. Net inbound migration data from the last 4 quarters shows a 93% decline from peak levels in certain zip codes. Meanwhile, developers are still delivering units that were permitted 2 years ago. Supply is arriving just as demand is disappearing. That combination is not a soft landing. That is a setup. And here's the thing about cities 10 through 6. These are the early movers. They're where Austin was about 18 months ago. Prices are softening, days on market are rising, and sellers who listed aggressively are quietly dropping their ask week after week. But here's what the national media isn't reporting yet. The median price data, the number you see in the headlines, is a lagging indicator. It reflects closed sales from 60 to 90 days ago. It does not reflect the nearly 50% of active listings in these markets that currently have price reductions sitting right now on Zillow and Redfin. The real-time data in the headline data are telling 2 completely different stories, and by the time the headline catches up, the equity is already gone. That's why we need to talk about cities 5 through 1, because these aren't early-stage corrections anymore. City 5 is already in free fall. City 4, the one we flagged in the intro, is being hit by a force that has nothing to do with the housing market itself. And cities 3 through 1 are facing a crisis so specific, so structural, that even owners who want to sell are running out of options. If you own in any of these next 5 markets, the next section is not background information. It's urgent. City 5 is Nashville. And Nashville is the bridge between the oversupply story and something more dangerous. Population growth is stalled, short-term rental regulations are tightening, and the investor-heavy condo market downtown is starting to see listings stack up with no absorption. But Nashville is still recoverable with the right moves. City 4 is a different conversation entirely. Washington, D.C. This is the one that kept us up. Because what's happening in the D.C. metro isn't a market cycle, it's a man-made event unfolding in real time. Federal workforce reductions tied to government restructuring efforts have already eliminated or threatened tens of thousands of government and government-adjacent jobs across Northern Virginia and the Maryland suburbs. And this isn't the kind of job loss that gets replaced by the next industry moving in. These are stable, high-income, long-tenure positions, the exact profile of homeowners who bought at peak prices with confidence they'd never need to sell under pressure. Here's why this moves faster than a typical correction. When a tech company lays off workers, those employees have transferable skills and usually land somewhere within 6 to 12 months. When a federal contractor loses a clearance-dependent position, or when an agency role simply disappears, the timeline to reemployment is longer and the geographic flexibility is lower. These homeowners can't just relocate to Austin or Phoenix for a new job in the same field. So they stay, they wait, and then when the financial pressure builds, they sell, all in the same submarkets at the same time into a buyer pool that is already watching and waiting for the floor. The D.C. market hasn't fully repriced yet, but the listings are beginning to move. Days on market in Northern Virginia suburbs are climbing sharply, and the price cut rate on Redfin for certain D.C.-adjacent zip codes has quietly crossed 40%. This is what the early stage of a man-made crash looks like, and the speed of it, once it tips, will surprise people. Now we get to ground zero. Cities 3, 2, and 1 are all in Florida. And Florida isn't dealing with one problem, it's dealing with 3 simultaneously, and they are compounding each other in a way that has no recent historical precedent outside of 2008. Start with insurance. The average homeowner's insurance premium in Florida has increased 181% over the past 5 years. Not gradually, sharply, with carriers either exiting the state entirely or repricing policies at renewal with almost no warning. For condo owners specifically, this has created a carrying cost crisis that is completely disconnected from mortgage rates. Your rate could be 3% from a 2021 refinance, and you're still getting crushed. Then add the structural safety assessment laws passed in the wake of the Surfside collapse. Florida condos built before 1990 are now required to fund full structural reserve accounts, and the bills hitting HOA members in South Florida are staggering. We're talking special assessments in the range of $50,000 to $150,000 per unit at some buildings. These are not optional. These are legally mandated, and owners who cannot pay are being forced to sell. That's why condo prices in South Florida are now tracking their steepest decline since 2009. It's not sentiment, it's math. And it's creating a wave of distressed inventory that is landing on a market where buyers are already cautious and insurance costs make financing more difficult to qualify for. Cities 3 through 1, Miami, Tampa, and Jacksonville, are not in a correction. They're in a structural repricing, and it is not finished. So what do you actually do with all of this? If you're a homeowner in any of these 10 markets, the single most important move you can make right now is to price to the market, not to the market of 18 months ago, and not to what your neighbor got in 2022. Pull the current active listings, look at what's actually closing, and price 10 days ahead of the trend rather than 10 days behind it. The sellers getting out cleanly right now are the ones who accepted reality early. The ones sitting on expired listings are the ones who didn't. If you're a buyer, this is the first real leverage environment in 5 years, and the play here is rate buy-down negotiation. Instead of asking sellers for price reductions, which they resist emotionally, ask them to contribute to a mortgage rate buy-down at closing. A 2-point buy-down on a $400,000 loan can save you more than $400 per month. Sellers are more willing to do this because it doesn't show up as a price cut on the public record. You get real savings, they protect the comp. Everyone moves on. And if you're a seller who's been waiting, the window is narrowing. More inventory is coming. Buyer demand is not recovering at the pace that would absorb it. Every month you wait in a declining market is a month where your negotiating position weakens and the buyer pool shrinks. The data is telling a clear story. Austin wasn't the crash, Austin was the blueprint. Now we want to hear from you. Are you in any of these markets? Are you seeing price cuts in your neighborhood, longer days on market, neighbors quietly pulling listings? Drop it in the comments. Tell us your city and what you're watching on the ground. The best real-time data we get comes directly from people living inside these markets. And if this breakdown gave you clarity on what's actually happening out there, not the headline version, but the real version, make sure you're subscribed. We publish fresh housing market data and analysis every single week, because in a market moving this fast, what was true last month may not be true today. We'll see you in the next one.